Hello and welcome to Startup Street. I'm Arundhati Ramanan and these are the top headlines from the startup space. Merchant SaaS platform Mintoke buys DigiLedge, marking the first acquisition in the central bank digital currency space. The deal will enable Mintoke's partner banks to offer more comprehensive CBDC-related payment solutions. Insurance Deco lands $70 million of investment. The funding will help Car Deco Group-backed Insurance Deco to expand its distribution network and strengthen its AI-driven solutions. FluxGen Sustainable, a climate tech company, received 28 crore rupees in a pre-Series A funding round. The funds will be used to scale FluxGen's AI and IoT-powered water management solutions, expand into new industrial markets, and strengthen customer acquisition. Ola's Bhavish Agarwal takes a leaf out of the Elon Musk playbook once again, asks employees to submit weekly reports outlining their accomplishments. The move comes amidst major layoffs at Ola, where the company is expected to cut over 1,000 jobs. Bitcoin declines over rising trade tensions and uncertainty around U.S. cryptocurrency reserve fund. Ether, the second largest digital asset, also felt the heat. Other cryptocurrencies, XRP, Cardano, and Solana, were also under pressure. Those were the headlines that we're tracking for you this evening. But on what's brewing today, fintech firm Cred has forayed into secured credit offerings with Cred Cash Plus, allowing its users to borrow against mutual funds in partnership with financial institutions, with interest rates starting at 8.99%. Cred recently launched a suite of credit management tools aimed at helping its members improve credit scores, manage multiple cards, and access secured credit without liquidating investments. My colleague Ritu Singh caught up with Cred's founder Kunal Shah on the sidelines of that launch event for more. Take a look.
Kunal, thank you very much again for speaking to CNBC-TV18. Finally, you've forayed into secured loans. This is something you spoke about the last time we had a conversation. Tell me what prompted the move and what prompted it now?
Yeah, I think it was something that was always there in our roadmap, but we wanted to create a user experience that feels magical, right? So let's just understand the product first of all. Cred Cash Plus is basically allowing our members to borrow against their mutual funds in the most frictionless manner, without any documents and without having to deal with a human call or any of that stuff, almost in minutes, and get very attractive interest rate, almost 8.99%. And the idea is that it's something that we thought it was always an ultra HNI product, where you always saw that this big businessmen kind of borrowed against their mutual fund or their stocks and enjoyed the low interest rates. But we saw very peculiar behavior where members were kind of breaking their mutual funds or FDs to kind of, let's say, have a temporary vacation, or let's say, get a wedding in the family addressed. It doesn't make sense from a compounding perspective, right?
Sure.
Mutual funds work when you keep compounding them versus break them for, let's say, doing a temporary transaction. You've lost that momentum completely, right? But let's say you may need money only for 2 years, right? Or 1 year or 6 months. I think this product works well for them. We believe that it was a use case only for business folks before, but I think it makes sense for every consumer now. And the same consumer now, instead of getting 15-16% interest rate on personal loans, could get a very attractive rate over here. There's no foreclosure, and with secured, credit score goes up, right? Which actually works really well for the members. And our model has been very clear: always encourage good financial behavior, always make the interest rates work for you and never against you.
You know, while I understand the philosophy behind this, you want to provide a seamless experience to customers. Interestingly, this is also coming at a time when the unsecured segment is slowing down. I know you've said before, the segment you cater to is not impacted, but the fact of the matter is banks and NBFCs you partner with to give these loans are slowing down on the segment. So did that play a role?
I think it just coincidentally got timed around the same thing. We've been building this product for quite a long time. Most products at Cred are usually cooked and baked for many, many months, probably quarters before we actually launch it.
Well, this started in November 2023, if you ask.
Well, we started building much before that, so it's been a while before we started launching it. The reason it works out well in terms of timing, because you're right, the partners are quite ready to kind of do secured, but to get that experience working well for you to work across your demat accounts, all your mutual fund portfolios, valued correctly, given to you in a seamless manner, limits given to you in the most positive interest, like positively good interest rates for you, I think just doing that integration is a little bit of an effort, because none of them have built these frictionless experiences before, right? And our goal was that if the ecosystem is demanding that and the consumer behavior is already shifting to that direction, be the one who's kind of being at the forefront of that. Yeah. Also, our consumer segment actually has quite a few, most of them have a large amount of AUM on their mutual funds as well, right? And we noticed that less than 1% of AUM was leveraged, right? If you go to more matured markets, it's very easy to imagine 20-30% of mutual funds being leveraged, right? And why should this not be the case over here? It works out really well from credit score perspective. It works out well for banks, balance between unsecured and secured. So the idea is to just kind of keep building on that momentum. But more importantly, is this the right thing for our members? The answer is absolutely yes, and therefore build it.
Will there be some kind of FLDG involved with your partners, or how would you be offering these loans?
I think when you think about secured, first of all, we do not participate in FLDG in most of the businesses we do. The reason is that we focus on high affluent customers, low interest rates. So FLDG is not a business that you will see in low interest rate businesses, right? Secured, on the other hand, actually does not have risk because it's a secured business, right? Yeah. So FLDG is not a very prominent thing or pronounced thing you'll see in any secured businesses anywhere in the world. So what happens is that we actually facilitate for the banks and NBFCs to make it easy for offering these things on our platform. We make our small fees on top of that for facilitating this thing or as a cross-sell ability on our platform. But there will be no FLDG in this particular category because of the nature of the product it is.
I know you don't really focus on revenues and certainly not profits, but with these additional product lines, could you give us a sense when you're offering 8% kind of starting interest rates? What kind of additional revenue do you hope this will unlock? And will we see more unsecured or rather secured products from you in future?
First of all, I think it's not true that we are not focused on revenue and profit, but I think we are more long-term about our business versus trying to make that quarter win, right? We're trying to build a business that will outlast every single member that exists at Cred. And therefore, the choices we make are much more long-term in nature, right? If something is right for the consumer and makes you less money, but eventually you will be able to enjoy the trust of them for 2, 3, 4 decades, the amount of money we'll make will be actually much more than anybody else over there, right? So always focus on being long-term. Always focus on long-term revenues. Long-term partnership goes with our lenders as well. All of our partners, we would be probably the largest partner for all of them because largely we focus on how the long-term partnership works, right? And if we are it's unsexy to build boring long-term businesses, but I think when it comes to financial services, that's the only way one should be building businesses.
Okay, with a long-term view, not really focused on short-term profits yet, but quickly a word on your loan book, which has crossed about 19,000 crores as of December. How fast is it growing, and what do you hope will be the contribution from the secured segment as you expand in this space?
Just a quick clarification, it's not our loan book, it's a loan book that
through your, yes, you do not lend from your platform, you do it with a distribution model.
Exactly. Yes. I think the growth rate is quite healthy. It's kind of keeping up to the market growth rates only. At least when it comes to prime customer, the growth rate is not slowed down as much as for the other segments. The growth rate is slowed down for high interest rate loans, short-term loans, and low credit score loans. When it comes to, you see the lenders are actually switching more towards more prime and super prime customers, right? Because they have demonstrated to be having much more resilience in these times, right? So we are actually seeing a decent amount of growth. Hopefully we'll announce numbers in the next financial results, but we are quite confident to continue the momentum. But we have been very proactive in ensuring that our promise to our lending partners is the best quality book out there, right? I think what we are able to prove in this time is that we are actually the best partnership that we can imagine, because even in these turbulent times, we've kind of been the absolute pristine book that they want to go after.
Well, some of the other products you announced today, for instance, customers being able to see their CIBIL scores on the app. What kind of monetization opportunities do you see from there?
Yeah, I think CIBIL score or building card management, these products are not necessarily designed from revenue backwards, but creating a good, responsible credit behavior. We want to create an ecosystem where A, we attract people who like being responsible with credit, B, attract the partners who like to lend to people who have these needs of solving for that, and every product that appeals to the people who are wanting to do responsible credit behavior is what we are building, right? So it's a self-selection of those customers, right? For example, people who are trying to take high interest rates or do misbehavior with the thing may not appeal to this. Like, we are this over-alerting, over-protecting platform where we say, boss, protect your long-term reputation. So it's a self-selection, right? We want to aggregate the best quality customers that eventually everybody will care about.
On that note, it is time for us to head into a short break. But coming up on the other side is special coverage from Web Summit Qatar 2025. Stay tuned. Welcome back. You're still with us on Startup Street. With increasing pressures in the labor markets, humanoid robots are becoming more commonplace. According to a report by Goldman Sachs, the market for these robots is projected to reach $38 billion by 2035. Agility Robotics is one of the leading companies developing and deploying humanoid robots. In a conversation with me on the sidelines of the Web Summit in Qatar, Daniel Diaz, the firm's chief strategy officer, outlined the firm's growth story. Take a look.
So Agility's been around for over 10 years. It was born out of the University of Oregon. And they were creating robots really designed and focused on locomotion, bipedal locomotion.
Right.
So 2 legs and moving around. I think in the last few years, the company's really focused on materials handling in the industrial space because there's such a huge need for labor. Right now, in the U.S. alone, I think there are over 1 million unfilled positions in materials handling, moving items from one area to another.
Right.
That they simply can't fill the jobs. These are repetitive, injury-prone jobs, lots of absenteeism, lots of turnover, and so humanoid robots with 2 legs and 2 arms are a great fill for that massive labor gap that just keeps on growing.
And, you know, your robot is called Digit, right?
That's right.
And could you sort of tell us how Digit is different from any other robot that's out there in the market?
Well, I think Digit is the only commercially available robot right now.
Right.
It's the only one actually doing work. So we've got great customers, companies like GXO, the big logistics player, Schaeffler, huge automotive parts manufacturer. Digit is at work in those facilities, moving materials around and helping lower the cost of labor. And that is a big part of what we're trying to accomplish here. Fill that labor gap and do it at a rate that's competitive to what a fully burdened human would actually cost. And what the great thing about it is with human labor in these areas being so scarce, companies can now choose where they want people to play a role and where they want to automate through humanoid technology.
Right, absolutely. And, you know, you just mentioned that you're with players like, you know, Schaeffler. You're also with Amazon, right?
Also with Amazon.
Yeah, so if you could sort of tell us, you know, how are you building efficiency for these companies and how does the business model work?
Right now, I think what was really most popular is this RaaS model, robot as a service. And so the way we price that is that, we examine the actual labor cost of the task we're taking on, and then we price our robot based on a discount of that fully burdened human labor rate.
Right.
We get up and running within a facility within a couple of days. So really what the customer is seeing is almost instantaneous ROI because of the pricing model. It works really well for Agility as far as the margins are concerned, and it's immediately valuable to the customer.
Absolutely. So, you're looking at this RaaS model, as you said, but where do you see the future of this? Where do you see these humanoid robots being able to make a difference, even going forward in other sectors? Because right now it's back-end, logistics, all of that. So where do you see this growing? What's the future looking like?
Sure. I think logistics is an area where there's clearly interest and need. Manufacturing is another one. We are getting a huge amount of interest in the automotive space. So Schaeffler's a good example, but the automotive manufacturers in Germany, the US, and Japan also becoming large customers for Agility. The pharmaceutical industry, retail, starting with back end, but then also moving onto the floor. Safety for humanoid robots, not just Digit, but all humanoid robots, is a very critical barrier to scale. Agility will be the first company to actually create a robot at the end of 2025 that can safely work in close proximity with people, which means these safety cages that they work in right now disappear for us. And then the ability to deploy at scale is almost infinite for us.
Yeah, so what is this new robot looking like? What are you going to call him?
So it'll be the 5th generation. It'll be Digit. It'll be the 5th generation of Digit, but it'll have this cooperative safety capabilities and a battery life like nobody else. So we'll have a 10-to-1 charge ratio on that battery, which means 10 minutes of charging, 100 minutes of work. So that robot's capable of working 20 hours a day, and it's capable of working in close proximity with people. So for us, that's the last big barriers to scaling this technology.
So, when we talk about robots working with with humans, what does this new workforce look like, right, going forward? Because, we're going to have the robots, we're going to have the humans. How do you see it impacting jobs? Are we taking away jobs with this robotics? Are we just creating efficiency? How do you see the new age, office space look like?
Sure. Well, right now we're focused on the industrial space, and I don't see robots doing office work anytime soon. And what's great about the areas that we're targeting is there's a huge need because of that labor gap. So I don't see robots taking away jobs. I see them fulfilling tasks that companies are having a hard time finding people for. Eventually, the robots will get more and more capable and more dexterous and safer. And then we'll have to think about what we're doing and where we're deploying people for the jobs that people are really great at. Jobs that require creative, critical thinking, digital jobs, managing these fleets of robots, maintaining these fleets of robots. That opens up a whole new set of possibilities for human workers that just don't exist right now.
So how many of your robots have been deployed right now? How many of your robots are out there, Digits?
I think with the various generations of Digit, there are over 100 robots that are out there, whether they're in academic research facilities or in companies. With the U.S. Navy, we have robots that are all over doing great tasks. The biggest opportunity for us, though, will be this next generation of Digit that's coming out, which will really open up the possibilities.
Absolutely. And what's 2025 looking at in terms of how many robots you're going to deploy out there in other companies?
Sure. I think we'll have, by the end of this year, probably close to another 100 robots that have been deployed doing advanced proof of concepts and pilot programs, and then actually fully being deployed. And then 2026, that number seems to just grow and grow. We've got a factory in Oregon where we build these robots that has a capacity to build over 10,000 robots a year. And so we're ready. We're ready for this big scaling moment.
You're ready for this big scaling moment. So then talk to us about the global expansion plan. Where will we see Digit robots out there, apart from the U.S.?
Sure. So, of course, the U.S. was our primary market. I think Europe is next for us. The demand there across the manufacturing sector is huge. Schaeffler's a great example of a strong foothold now in the European Union. Asia, Korea, and Japan specifically, there's huge interest there, and we'll continue to grow from there. But those are the markets that we're going to primarily target.
So, if we talk about the Asian market, is India part of the picture? Where do you see India in this robotics game?
I think that's obviously a huge possibility for our opportunity for us in India. I think we have to think about the labor rates and what the prevailing labor rates are and whether the economics of humanoids at their current cost structure makes sense. But I absolutely see that as a market because the Indian market, labor market continues to evolve and grow and change. Humanoid robotics and automation will become a bigger part of that economy.
We get you more from the Web Summit in Qatar. On the sidelines of the summit, I also spoke to Jim Bankoff, the CEO of Vox Media. He believes sky is the limit when it comes to AI. That's not all. He also spoke about the company's global aspirations and his desire to enter the Indian market. Here's a slice of that conversation.
There's a lot of different places where AI is going to be important. Some are predictable and most are not. So I will say for our business, first of all, we put human creativity still at the center. So we ask ourselves, how can AI help elevate and enable human creativity like never before? We have a few applications that we've launched in our own portfolio. One of our media brands is called Eater, and Eater helps people discover great places to eat and food. There's so much content that our reporters are coming up with every day. We've used AI to make that content more accessible, so value. So we're exploring all of it, and really, the sky is the limit in terms of opportunity.
So you said that, you try to keep it human-centric and you use AI to sort of boost that. But also the other bigger issue right now is while we have professionals who do this work, we've also got the advent of social media. We've got so many, social media creators who now also are partaking in journalism. So how does this pose a challenge or a threat to, let's say, traditional media outlets?
Right. Well, first of all, I think it's wonderful that media is so accessible to people, creators. We work with a variety of creators. We help them grow their audiences. We help them monetize as well. We have a whole part of our business. Frankly, the fastest growing part of our business is called the Vox Media Podcast Network. And it's podcasts on YouTube, it's podcasts on TikTok, etc. And so we go out and we find great creators.
Deep fakes and, misinformation has become such a big problem in a social media era, right? So how do you sort of circumvent this? How do you use AI or technology to sort of, stop this?
Yeah, well, first of all, I think part of the value, you asked me, there's so much change, and media is always defined by change, technology, change of taste, change of the economy. And so we always have to stay on top of it. But one of the things that I find is that the consumer has a place for trust, and trust is really paramount, and we're smart people and we can sift through over time. Maybe you can fool us once, but over time you can sift through what is trustworthy and what is not trustworthy. So we, like CNBC, like other great media outlets, have to find ways to provide that trust. And I think technology can, if channeled the right way, can play a role in helping to identify what is trustworthy and what is real. And I think ultimately over time, there's going to be demand for that. And if we can do our jobs well, I think the consumers will trust us and the consumers will value us. And the algorithms that support the discovery will also surface us in the way that they should, because it's in their best interest to do so.
Right. And speaking of that, how do we ethically use AI? What sort of guardrails need to be put in place? And does the industry do that, or is that something the government needs to do, or do both need to come together? So what kind of guardrails are needed to protect people from AI, their privacy and data?
Well, there's so many moving parts to answer that question successfully. I think ultimately it starts with empowering consumers, giving them the tools and the algorithms to have the choice and the say in how they consume this media. And then, of course, there's a role of educating people to understand where there's disinformation, understand how they can kind of take control and get the information from the places that they trust and they value. That will be each individual's choice, and they have to be given that choice. And I think technology can assist that. I think government can play a role, but I think it's also incumbent on the free enterprise to make sure that they are acting responsibly, because ultimately it's in their best interest to do so. And I think there are plenty of good actors. There's a lot of things that need to be figured out. There's a lot of opportunity for exploitation. There's a lot of bad things, just like in any other industry, that can happen, and we have to be on alert for them. We have to allow innovation to foster, so we can't overdo it, but we have to be smart, and we have to continue to iterate through that.
Yeah, so you have to use it responsibly and not have too many guardrails in place as well to sort of dampen innovation at this point.
That's right. Learn, test. Some guardrails make sense, of course, but we have to be careful because things evolve, and what might be a good prescription in one era or can change very quickly based on how technology changes too. And so, I think often it's the responsibility of the companies that are producing these technologies to make sure that they're on top of it. And again, in the long term, I would hope it's in their best interest to do so as well.
I just wanted to ask you, what's the Vox Media expansion plan? Are you eyeing other markets? Are you looking at India at all? Are you planning on entering the India market?
I would love to enter the India market, but we need to be very humble as we enter the market. It's an enormous, thriving market.
Yeah.
I don't have to tell you that.
Yes.
But we are an American culture, and so we have to go about it in the right way, whether that's via a partnership or whether that's via working with people on the ground who are experts, not only experts in the culture and the taste of the journalism, but expert in the advertising markets, expert in the business markets as well. So we are very careful, that we're a very ambitious company. We have global aspirations, but we're very careful and we don't want to take an arrogant approach just because something works so well for us in North America and in the countries that we operate. I will say we already have large audiences in India who already go to The Verge or go to Vox or go to SB Nation, who listen to our podcasts. We reach large swaths of the English-speaking world as it is. Having said that, we do aspire to not only be American-centric, but to be global as well.
Absolutely. And what about the 5-year growth target for Vox Media?
We want to continue to serve large audiences, and we want to meet audiences where they are. We want to have a dynamic business model with revenue diversification. We see a lot of opportunity right now. All of the landscape of media, because it is being disrupted so quickly, that creates opportunities for companies like ours that are traditionally disruptors as opposed to ones that are less nimble. We have built a successful business model, but we are not tied to an old way of distribution. We are not tied to a printing press or a broadcast network or anything like that. And so we have opportunity to continue to innovate and continue to grow. And I expect, and I know we will hold ourselves accountable for growing dramatically.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.